Hi, in a previous lesson, I did explain on the rules of T account for asset, liability, and owner's equity, or also known as a capital. And up till now, you should understand what is asset, what is liability, and what is owner's equity. To recap, asset is something that business own, and increasing in asset show the increasing in what business has. Liability is what or something that business owed to the third party, normally from a bank loan that business made, and when business bought a goods on credit, which is from creditor. Liability show that the business owed something to the third party, which is from a bank loan that business made, and from a supplier when business made or bought goods on credit, which is in accounting we call a supplier as a creditor. How about owner's equity? Owner's equity is value that business owed to the owner. When owner bring in his or her personal belongings into business. When owner bring in his or her personal belongings into business, that one we call as a capital. So a capital is something that business owed to the owner. And capital is a part of owner's equity. So today, I will show on how to record a transaction using a T account. And you should remember, when we want to record a transaction into the T account, we need to fulfill 3 steps that I explained before. The 3 steps involved is, first step, you determine the account affected from the transaction given. Step number 2, you identify which account should debit and which account should record in the credit side. Step number 3, you record the transaction in T account. Look at the first example. Example 1, the transaction when the owner start business with RM 5,000 cash, which means owner bring in his or her personal money into the business, which is in cash, so that you need to fulfill the 3 steps that I explained before. So the first steps, identify the 2 account effect from these transactions. So, as I explained before, when owner start business with he or her personal belongings, it shows that one account effect is a capital. Another account that effect from this transaction is cash, which means when owner bring in his or her personal cash into the business, so that it increasing the cash account for business, and also it incurred another one more account which is a capital for business. Step number 2, identify which account should be a debit and which account should be a credit. Remember, as I explained before, the asset account always increase. The asset account increase should record in a debit side. So in this case, the cash is one of the asset account. This is the cash involved in the business. So that it shows that when the owner bring in her or his personal money 5,000 into the business, it increasing the business cash. So the asset account increase. Specifically in a particularly, the asset account involved is the cash. So the cash account debit. Another account which is a capital, we record in the credit side. Why capital in the credit side? Remember, the increasing in liability and increasing in owner's equity always in a credit side, which means now capital is a part of the owner's equity account. So that increasing in owner's equity account recorded in a credit side. So now we record this transaction in T account. So we already identify the 2 account affected from this transaction, which is the cash and also the capital. And we also understand that debit side is always in the left hand side and credit is in the right hand side. The same goes to the capital account. In the step 2, we already identify that the cash account will be debited by 5,000 and the capital account will be credited by 5,000. So, what we need to record as a description for this transaction in the capital, in the T account, so that we assume or we identify the item that we need to describe is the cash increase, the cash account increase by 5,000 from the capital brought in by the owner. And the capital account now show that it increasing in a capital account or owner's equity account, which means the business now owed to the owner because owner bring in their cash by 5,000, which means the business now have a cash of 5,000 from an owner, so that the capital account increasing. The capital account is a owner's equity account. It's a part of owner's equity account, and remember, increasing in owner's equity account should record in the credit side, and increasing in the cash account should record in a debit side. So now we fulfill a double entry situation, which means cash account recorded in a debit side and capital account recorded in a credit side. Now we look at example 2. In example 2, the transaction is the office equipment was purchased for cash RM 450. So back to the 3 steps that I explained before. First, you identify 2 account effect. So from here you should know the 2 account affected from this transaction is office equipment account and also the cash account. Steps 2, you need to identify which account should record in the debit and which account should record in the credit. Office equipment purchase for cash, which means we use our business cash to purchase office equipment. So our cash reduced by 450. Remember, asset account reduced should record in the credit side. And now we buy or purchase an office equipment. Office equipment is one of the asset account, so that we debit office equipment. It shows that our business asset increase. So now in the step 3, we record this transaction in T account. So we identify 2 account which is office equipment and cash account. Since we already identified the asset which is office equipment is one of the asset account which is increasing in asset account, record in the debit side, which is we record 450 in the debit side, and decreasing of asset account which is the cash account record in the credit side, so that we record cash in the credit side 450. So the description that we need to record is we bought an office equipment from a cash, and the cash now reduced when we purchase office equipment, so that it consider a language in accounting, which means from these 3 account itself you understand what the transaction occurred, which is the office equipment has in the business from the cash, which means we bought a office equipment from a cash. This is considered a reverse when we made a T account. When we prepare a T account, the description is actually a reverse. Now we look at example 3. Okay. A building was purchased for RM 58,000. 58,000 and was financed by a loan from bank, which means we bought a building with the cost of 58,000 from a bank loan. So for the first step, we identify two accounts that involve, which is building account and also a bank loan account. Step number 2, identify the account in the debit side and the account in the credit side, so that when we bought a building, it shows that our business asset increase in business asset, which is building, so that we debit a building account. Another one, account that effect, which is a bank loan. Remember, bank loan is a liability account. Liability account increase when business owed to the third party. So in this case, consider that business owed to the bank. So when business owed to the bank, it shows the increasing in liability, so that we record a bank loan in a credit side. So for the step number 3, we record in T account. So how to record in the T account? We already identified two accounts, which is our building and our bank loan account. Debit in the left hand side, credit in the right hand side. So now the building is the asset account. When the asset increasing, we record in a debit side. So the building we record as a 58,000 in the credit side. And we bought the building from a bank loan. So bank loan is a liability account. Increasing in liability account must record in the credit side, so that we record 58,000 in a credit side of the bank loan. The description is reverse, as I explained before, so that the building is bought from the bank loan and increasing in liability from a bank loan that we made. Why we made a bank loan? Because we bought a building. So it is reversed. Next, example 5. In the example 5, a car was purchased for 24,000. Half the cost was paid from a bank, a business bank account, and another half was financed by a loan from a bank. So that we identify the 3 steps first. So the first step, the account that affect from this case is a car account. Next, half from this car value is paid from a business bank account. So a bank and another half from a loan from a bank. So a bank loan. Next, we identify the account that should be debit. So now a car was purchased for 24,000. So this is a car value. The car value represent about the asset that business has now. So increasing in asset, record in a debit. So account that should be debited is a car account. Credit should be the account that should be credited is the bank account. This is the business bank account. When we use the business the money from a bank account, so the asset decrease, which is the money in the bank, the money in our business bank decrease. So the one account that should be credited is our business bank account. Another one account that should be credited is a bank loan account. Remember, it is a liability account, which is when we or the business owed to the bank from a bank loan that we made, it shows the increasing in a business liability. So increasing in business liability showed and recorded in a credit side. So step number 3, we record in the T account. So that we identify 3 accounts for this transaction, which is we have a car account, a bank account, and a bank loan account. We have a debit in the left hand side and credit in the right hand side. So that we identify that we bought a car, the cost of the car is 24,000. So that we paid from our business bank 24,000, cost half from it, which is 12,000, and another 12,000 from a bank loan. So now in our bank account, it shows a reducing of 12,000. Why a reducing of 12,000? Because we bought a car. And the same thing goes to the bank loan. Now we incurred a liability from a bank, which is from a bank loan that we made. How much the bank loan that we made? 12,000. Why we made a bank loan? Because we bought a car. So that it shows that the transaction completed with the 3 accounts involved. I hope until now you should understand on how to record the transaction in the T account.